Disclaimer. Trading financial instruments carries risk. This material does not contain investment advice, nor should it be viewed as a personal recommendation, or an offer of, or solicitation to trade in financial instruments. Past performance is not a guide to future results.
Hello everyone and welcome to a new ATFX video. My name is Gonzalo Canete. This is ATFX Connect section of Market Snacks, and I am one more time here to share with you a quick recap and update of the global financial events that is affecting the market. They are affecting the market, and so the whole target goal of this video is just summarize in a few minutes what happens for the last few days on the financial markets. And one more time, let me remind you that if you go to atfxconnect.com, you can access to the section of the blog Market Snacks, and you're gonna find the report I publish every single day here. As you can see, there is the last 3 days reports of the week with a summary of not only macroeconomical data, geopolitical events, but also a revision view, interpretation of what's the effect of those events on the price of the main financial assets, including equity, commodity, currencies, even crypto, and forex. So you can see a 360 degrees of the market just by reading this report, and you got the summary every single day freshly here. Now, saying that, let's go to recap everything. I did the summary of the week a few days ago, but you also gonna see now, so far, today is Wednesday, 27th of March. We're gonna see so far how it's going the market, what is going on, what's the last news, the last updates, and most importantly, what's the last key points or interpretations about what is really going on. Because as you can see, check the news is easy, understand what is behind that news and how these news are actually affecting the market is completely different. We need to interpret what exactly is the market reading or metabolizing behind this data and how this is affecting the price. That's why I would like to start with two main points. Last week we saw, the end of the week, how the Bank of England was actually announcement openly the door to cut interest rates in the future, in the coming future, which is something that a few months ago it was not even in consideration. It was not even on the point. It was not on the table for the Bank of England. But for the first time, the governor of Bank of England was accepting the possibility, the chance, the option of cut interest rates in the future, following the Federal Reserve strategy and following also the Central Bank of Europe speech and so on. Therefore, Bank of England is also considered to cut interest rates. We explained many times in the previous videos why we believe this is not actually really honest, because if you go to inflation rate 4% for the United Kingdom, you will see that actually is not getting reduced. Saying different terms, as you can see, this is what I'm focused to repeat all the time in this case. You can see that inflation is moving in a kind of zigzag. We got in October, 4.6% on inflation rate, November 3.9, December 4% again, January 4% of inflation rate again, 3.4 in February 2024. Therefore, yes, United Kingdom is reducing inflation, is good numbers, but still we know that in November it was 3.9 and in December 4%. We need to see that this is actually trustable numbers. We can actually trust in the process that the inflation rate is getting reduced. And so far the main problem with this, and I don't want to go too technical at this point, but if you observe the jobless rate in United Kingdom, unemployment rate is so low. It's 3.8%, moving up to 3.9%, but still the main factor that is causing inflation right now, the core inflation, if you analyze the factors inside of the inflation, you will see that one of the sectors that is the head one leading the inflation is the services. Services is a sector that is using high levels of labor force, and therefore it means it's mainly fed by labor cost. Labor cost means, like, if unemployment rate is low, and is the case, is low, it's less than 4%, and if you take a look in long history, we are in a minimums, historical minimums of unemployment rate in the United Kingdom. Therefore, low unemployment rate in the United Kingdom is one of the reasons that is concerning the Bank of England, because if the unemployment rate is low, labor cost is going to keep high, and therefore inflation based on services is gonna stay there for a at least middle term. That's why they need to adjust the labor market, and this is something that's affecting also to United States. That's why Federal Reserve is talking again about cut interest rates, but is taking one step forward, one step back, based on the comments done by Bostic, by Gulbsy, by Waller also. I got a few comments of them here, so let's bring in the comments on the topic now related with this, because everything is connected in this case. So Bank of England is considering to cut interest rates. Still, it's a long story, and moving from there to Federal Reserve, we listen tonight one of the members of the board of the Federal Reserve, which is Waller, speaking at 10 p.m. UK time. And it's interesting to follow what they're going to say, because Bostic and Goolsbee say at the beginning of this week that they are expecting an interest rate cuts this year. But pay attention to this. Bostic, for example, was saying he's expecting at least one interest rate cuts for 2024. Both of them suggest by the end of the year, only one interest rate cuts. However, Goolsbee, he was talking about 3 interest rate cuts in 2024. I was shocked by the fact that especially Bostic was mentioned that the interest rate cuts could happen by the end of 2024. Remember, when Jerome Powell mentioned this, it was in December 2023, and it was expected to get the first interest rate cuts by March. It didn't happen, and my feeling on this is they're gonna keep moving forward the interest rate cut decision, and at some point the market gonna realize that all of this is actually a fake statement from the Federal Reserve, and maybe they need to rectify the position they got it. The proof of what I'm saying is not exactly discarded by the market, and it's actually something that this could be considered by the financial market. Is if you check the yield on the bonds, which is positive correlated with interest rates, it was not exactly dropping. As you can see, it was dropping by the time Jerome Powell mentioned this. Has been flat below 450 yield 2-year bond, treasury bond in the United States. The yield was below 450 until the end of February, half of February, when the investors find out actually that interest rate cuts, it was not happening in March, and therefore they start to sell again the bonds and keep the money again in deposits. By then the yield was rising back again, dropping again with the labor market showing an increase on the employment rate, which it was confirming that this inflation problem was not there anymore, and therefore the Federal Reserve can cut the interest rates. But after that, inflation rate, general inflation rate was rising, and therefore it was also concerning the expectations of the market, because if the inflation is rising, interest rates cannot be cut by the Federal Reserve. And again, now it's dropping because Jerome Powell was insisting last week. Jerome Powell was insisting that interest rates gonna happen, and then it's dropping again the interest rate. So we can follow this. I mentioned this in the previous videos. 2 years bond, treasury bond of United States, free risk bond. You can follow this one to measure the temperature of this decision. If it's actually true, if the market is actually trusting in this decision, this yield gonna drop. If it's not true, the yield gonna keep rising. As we can see, it's now higher than January and February, and therefore that's why I believe today the expectation of interest rate cuts is lower than at the beginning of this year, and it's obvious watching the market. Another factor that is supporting this idea is the rise of the dollar index. If the interest rate gonna get cut, the dollar index should make the dollar weaker instead of stronger. And for the last couple of weeks, let's say since 10 of March, Friday 8th of March, the dollar index has been rising. It was dropping during the Jerome Powell speech, but still is recovering and pushing forward and forward to 450 points. And this is another signal that is giving us the feeling that actually the interest rate cuts are not gonna get cut soon. And it's very interesting because if this is confirmed, and after all we can see that actually interest rate cuts are not happening, obviously these amazing levels achieved on equity markets on United States, and particularly in Europe, if you take a look on DAX 40, the speed of the market is rising and incredible angles, you know, super vertical, rise, super vertical bullish market, and therefore the correction can be aggressive. If you take a look also in the daily chart, take a look on this. It's incredible. It's incredible. And in long term, it's even more ugly, the chart, because in long term you can see this is since 15 years chart on European equity, and as you can see, everything points in a very ugly way, because sooner or later a correction needs to happen in the European market, and by then it's gonna be dropping probably for 2, 3, 4 months at least, as you can see on our charts. So again, the dilatation of the price could even take the DAX 40 German main index to 18,800, 18,000, 19,000 points, and then what? That's the main question, right? So they cannot keep forever this positive effect on the market based on the interest rate cuts that are not happening. And the macroeconomical data for Germany is not actually good. It's the worst in many, many years. And as you can come here and check also what is the numbers for Germany. Where is Germany here? Growth rate. This is the growth rate of Germany. So as you can see, it's a disaster. And if you can justify new maximum, record maximums on German equity based on these numbers, obviously something is wrong. Okay, exportations, industrial production, but in general terms, at the end of the day, growth rate is negative in Germany, not for one period, but 1, 2, 3, 4, 5 months, either with a minimum or zero growth rate or even negative growth rate for the last, not 5 months, sorry, 5 periods, which is 5 quarters, the whole year of 2023, the last quarter of 2022. Obviously not good at all. So that's why I believe that at some point European market gonna suffer a massive correction. Dollar is rising. Also, you take a look on euro dollar. Obviously, what we can expect if the European markets are experience a negative correction, a bearish market, it means sells on European equity. If you sell European equity, probably you try to put your money in another kind of assets that is giving you better returns than Europeans, because they are dropping, obviously. Either you go to fixed income, either you go to another currency, which is you choose financial assets, yes, but in a different currency to protect the depreciation or the loss of value of these dollars, of these euros that you are selling. Anytime you sell a European stock, you are selling the euro to recover. If you are a Japanese investor, if you are a United States hedge fund, for example, you are selling the euro to recover your main currency and therefore pushing down the value of the euro in international markets. That's why I believe the relation between euro dollar is gonna go down in long term based on this macroeconomical effect of lack of growth rate in Germany, lack of economic growth in Europe. It's going to lead to investors mainly trying to find another source of value, probably United States, maybe in Asia, China, Japan. Any case, Japan is a very interesting also point, because I mentioned on the report published on Monday on Market Snacks, one important factor could happen on fixed income market, on bond market, which is caused by the strategy of increased interest rate in Japan. Again, increase interest rates, the opposite strategy from the Federal Reserve. If they decide to increase interest rate in Japan, what they're gonna cause maybe at some point is disincentive on the rest of the bonds in the rest of the world. Bond market for Japan is not attractive at the moment for the last few years, basically because the Bank of Japan is feeding constantly that market, and therefore is keeping the yield of those bonds super low, with not at all an attractive return for investors. What happens now? If the Bank of Japan is actually serious increasing the interest rates, and they're gonna reduce the liquidity on bond market, which is something by the moment they didn't say. They say they're gonna increase interest rates last week. Remember, recap. Last week they mentioned that they're gonna increase the interest rate. They did actually from minus 0.1 to 0 to 0.1% range. But I say they're gonna keep buying bonds regardless. It's at some point they actually let the yield rise, the yields on the bond rise. those yields gonna start to be attractive, interest rates gonna rise, and therefore Japanese investors, and we're talking about the second biggest equity market in the world. If you take New York Stock Exchange, it's the biggest exchange in the world. The second biggest by size is the one in Japan, in Tokyo, and therefore Nise is one of the main sources of money and speculation on terms of capital markets, and that's why I believe if the interest rates are rising in Japan, they are gonna start to move value from those risk-free bonds, from those bonds that they are keeping in Europe mainly, because United States is doing well. United States is still a source of safety for your money, but Europe, in the case of Europe, is the opposite. Europe is in troubles, and therefore the European bonds is maybe not the best option. And if Japan is giving you good returns on their bonds, you're probably gonna choose to at least diversify your money between European bonds and Japanese bonds. And it seems to be true, because I read one of the comments published on Reuters done by one of the strategists from Nomura, who was saying that apparently French Treasury is worried about this because they are contacting the Bank of Japan and making many questions about what's the strategy in the interest rates, and therefore they believe it could get affected. French bonds could get affected by the interest policies of the Bank of Japan. Very interesting point. So keep in your radar. In the other hand, also keep in the radar the movement of Japanese yen, because it's so interesting. Take a look. This is the triple bottom that is triple floor that is rising right now, the pair 151.30, and again this one that you see here on the top on yellow, which is 160, it's coming from an historical maximum achieved on April 1990, which is right here. Boom, 160, and we are getting close to 160. Amazing. If these levels actually happen, I'm sure that it's gonna be one of the golden areas for shorts for many hedge funds who are trading between Japan, United States, and even just any other hedge funds that are looking for make big returns in long term. I think that's in general terms this is all. I was explaining also, I got a few notes here to explain. Last news, we got also the Baltimore cargo ship, the accident happens. Some analysts are talking about how this could affect in middle term to inflation in the United States. Probably not, because I check also the value of the goods passing through this channel are around 28 billions per year, 28 billions of dollars per year. So it's not a massive amount. It's one of the quotes, one of the data quotes by the reports on Reuters. But he also say that still it could cause some stress on the supply chain, and therefore it could cause potentially an increase on inflation. So that's regarding the Baltimore cargo ship accident. Now, we also got certain news that make us more concerned about geopolitical stability. Take a look on gold market, by the way. Another incredible market is rising to a new maximum, historical maximum. It's not dropping at all. It's pushing forward and forward the price. So I believe this movement in gold is not caused by weaknesses in the dollar, because as you can see, we checked a few minutes ago, dollar is rising and it's getting stronger. 104.50 points almost, 104.50, which is it's just indicating that dollar is getting stronger regardless the interest rate cut decision, yes or not. Gold is rising. Why is rising? Well, maybe it's rising because one of these news that I was just let me grab the source. Let me grab the source here so you can see exactly the whole news. But it was a very, very disturbing news saying that the Secret Service of Russia, let's check here, the Secret Service of Russia, the FBS, is considering that maybe not only Ukraine but also United States or British, United Kingdom government could be related with the terrorist attacks on the last weekend. So these kind of conclusions, it could be nothing, it could be just noise, increasing the tensions between NATO and between Russia, or it could be a very serious accusations. And if Russia is taking this serious and they really believe that there is a connection between them, it could at some point take us to a new scenario of an escalation of the tensions between both both blocks, right? The NATO bloc and the Russia-China bloc. Zelensky also, he just said, has a Secretary of Defense, the new Secretary of Defense, the head of foreign intelligence. I don't know if this is related with what happens or not, but head of foreign intelligence of Ukraine has been hired as a Secretary of Defense. He replaced yesterday the previous one, and he put this guy on chart right now. Also, the last data that I didn't mention, and it's on the economical calendar, I believe, for today, it was the one coming from China. Improve on industrial earnings. It's showing to us, let me see if I can find, actually, it was yesterday night or when? It was actually showing us an improvement from the last 2 months of the year, January and February. It's increasing 10.2% year to year. And if you check 2023, that industrial earnings, it was actually negative for almost the last few months on 2023. Therefore, is giving us a clear signal that the trend is changing in China. Why is not here the data from China? It's changing the trends on China, and therefore, it's improving the expectation, the economical expectation on China, which it was one of the main concerns on the global economy, that China could be eventually slowing down. Is not the case. So again, that's one of the important topics we should discuss. Probably is because the impact is one start on investing.com calendar. Let me check, because I can show you also the historical and the chart, which is interesting. Here it is. Chinese industrial profit. If we open, we can see the historical, and as you can see, was negative since when? Since a year ago. Since March 2023, and finally we are in 10.2%. Remember, this is a reading, this is a score year to year, so it's measured every single month. So far, it's 10.2% year to year, and the last 2 months obviously has been positive, and it has been changing the trend on the Chinese industry. I think that's all, and I hope this video helps you. Remember, if you like this content, please leave me comments, give me thumb up, subscribe the channel, and let me know that you are following this to encourage me to keep doing new updates. If you also want to receive on your email the newsletter that I'm doing by email every morning, just subscribe, send me an email, and I can just add you on my playlist, on my list, the newsletter list. Is completely free. So you can receive on your email completely free this market update. Okay, take care and see you in the next reports. Bye bye.